Let's connect with Sunil Singhania to talk about where he feels markets are headed. We haven't had him on the channel in a while, so that's Markets and More with Sunil Singhania, where we'll of course talk about near term and medium term. Sunil, fantastic to have you back on ET Now. Here's hoping that everything is fine, your family, your children, everything is fine at home.
Lot, Nikunj, and I wish the same for you and all the viewers. Be safe, be healthy, take care.
Thank you for that, Sunil. Sunil, the market reaction to the surge in second wave, do you think that was overdone, or this time for a change markets have not really cracked, they've simply corrected in pockets? Do you think markets have reacted in a very measured manner to the rise in second wave?
So, Nikunj, there are 2-3 aspects to it. One is anything which comes and hits us for the first time always has a bigger impact. And that is what happened last year when we had the first phase of massive, numbers increasing and lockdowns happening all over the world. And the markets definitely corrected a lot. This time, obviously, the numbers are much higher than what they were in the first wave. But to some extent, investors have taken a cue from what has happened in other parts of the world. So, for example, in the US, when the cases were rising, markets behaved a lot more maturely. Even in the UK, we had 3 months of lockdown, but the markets continue to touch all-time highs. I think the whole optimism was that, yes, cases are rising, but so are the number of vaccinations which are being administered. And even in India, I think the moment investors have started to get a cue that the government is on the, is on the job, number of new vaccinations are being approved. And maybe this number of 3 million a day might be ramped up to 6-7 million a day in the next 3-4 months. I think that is giving optimism. And that is the reason that despite the near-term concerns of not only the economy, but the near and dear ones suffering, investors are willing to take that call that in 3-4 months, things would be much better than what is the situation now. And I think that is exactly what the markets are demonstrating.
Sunil, the template, let's say in March was, we would be in for a year of grand recovery. We will get earnings upgrade, capex will start, and the economy will move to a different orbit. Because of what's happened, unfortunate though, can those optimistic opinions and assumptions, will they get challenged?
So, Nikunj, I think we continue to believe everything which you mentioned. We are very sure that the demand on the ground is very strong. I think countries all over the world are spending a lot of money on infrastructure, and that is leading to demand across the product profile. Export demand is very strong. The numbers of Indian exports month after month show very healthy growth. This China 1+1 strategy definitely is in the works, and a lot of Indian products are benefiting out of it. Protection to Indian industry is definitely there, and that is helping profitability. Yes, there are some headwinds in terms of raw material price increases and this near-term lockdowns of 1 week, 2 week, 3 week, depending on the state you are in. But I would be on the camp of being optimistic. As I said earlier, there is definitely a view that in the next 2-3 months, the number of vaccines which would be administered on a daily basis would be maybe 2 times of what we are right now. And that would mean that by October, November, almost 80-85% of the population over 45 would be vaccinated, and almost 40% of the total population would be vaccinated. And globally, we have seen that the moment 40% and above of the population gets vaccinated, then the number of cases come down quite dramatically. I think the other thing is, the little bit of, I would say, panic is also because of this view that in case someone gets infected, hospital beds are not there and, ICUs are not available. I think all the state governments are working towards it. There is a positive news that remdesivir might be administered in a non-injectable form. I think a lot of progress is being made. So I have always believed that being optimistic has worked for me over the last 20-25 years, and I'll continue to believe that being optimistic will work even this year.
An equity investor, the single biggest quality which you need to have is optimism. And I always say this on air, triumph of an optimistic. Good news and good prices, remember folks, don't come together. This shall also pass. This shall also pass. But if a financial investor, use bad news to your advantage to invest, and that's what I think Sunil is again referring to. So Sunil, has there been a change in your portfolio positioning? We've not spoken in a while actually. Last time when we spoke, you had a large exposure to mid-cap IT, some exposure to pharma, and a big exposure to steel.
So I think we continue to maintain our view on the markets, and we have a diversified portfolio. We do have exposure to steel. It's not a big exposure, but we have a decent exposure. We continue to believe that IT and pharma are two sectors where Indian companies have global advantage. And I think they will continue to grow at decent mid-teen levels. And I think this is what is, demonstrated that if you have a diversified portfolio, then, the stability in the portfolio in these kind of markets helps a lot. In fact, I was speaking to my team today morning, and I can tell you that even this month, April month, our portfolios are in the positive. And I think that is only because of the diversification and the diversified, range of stocks we have. So, Nikunj, it's very easy to get carried away by what is happening in the absolute near term. Someday steel would be in favor, someday, sugar will be in favor, someday yarn would be in favor, and so on and so forth. But as a long-term investor, I think you have to create a portfolio which justifies investing from a 3-4 years perspective. And specifically on IT, if you actually look at it, I think the commentary from IT companies, the results of the 3 of the major companies that have announced results have been very positive. Rupee has depreciated from 72 odd to 75, which is going to be a tailwind for both IT as well as pharma. I think this COVID, the number of cases will come down, but I think this is going to be there in our life at least for the next couple of years. And that would mean that the opportunities from a pharma perspective, not only domestic but exports, would continue to be quite up there. So, I would say that there has been no significant changes in the portfolio over the last 2-3 months.
Sunil, the way you value companies is that you look at P multiples and you also look at the discounting cash flow. Now, if inflation scare is back in parts of the world, and if the trend in steel, cement, and soft commodity continues, inflation will come back here as well. P multiples, they normally compress when inflation comes back and interest rates go higher, and that will start impacting valuation of growth stocks. Won't that be a challenge for IT pharma, because these are not cheap sectors now?
So, Nikunj, I think all what you said is definitely perfect textbook, but practically things are not as simple. In fact, inflation normally is good for corporate profits because, your sales and profits will grow in an inflationary kind of an environment. But that apart, our view is that, yes, inflation will inch up, but it is not going to be something which is going to be very scary. I think it is possible that interest rates might not go down from here, but we also don't believe that they're going to rise in a hurry. Across the world, central banks are very clear that their economies need a little bit of support for at least the next 3-4 years. And therefore, whether it's the US Fed or the Indian RBI, they have very vocally said that they would continue to maintain a high liquidity and low interest rate regime. And we would believe that that would be the case. In fact, what typically happens is that, particularly for a diversified country like India, we have companies and sectors which benefit out of this inflationary environment. And then there are some companies and some sectors which get impacted because of this high inflationary environment. And therefore, it balances out. So at the margin, the profit growth for Nifty might continue to be what it was this increase in commodity price, or in fact go up. As far as IT and pharma are concerned, they don't get too much impacted by this inflationary environment because their raw materials ratio to the sales is very low. In IT, it's only the manpower cost, and there is a tailwind because rupee, as I said, has depreciated by 2-3%. So we are not unduly worried about these sectors. Yes, the high P sectors might get impacted because of the discounted cash flow. The rates go up, then companies which are trading at 70, 80 P multiple might suddenly look all the more expensive.
So Sunil, is it by design that you have a slightly outward-looking portfolio, IT, pharma, steel, they're global sectors. Steel prices are a function of not local demand, but global commodity prices. It's converted back into rupees. IT, a complete play on global demand. Pharma also a bit of domestic, but more global.
No, so you are right, Nikunj. For the last 15 months or so, we are trying to balance our portfolio, with inward-looking sectors and matching them with global focus sectors. So, actually, if you look at the world, I think the first countries or the regions to rebound would be countries like US, obviously China. UK has already opened up. Our view is that Europe, it's a matter of a couple of months before it starts to open up. So I think the opportunity in the immediate near term might be more for global sectors. But, we don't have to forget the fact that after a very progressive and growth-oriented budget, opportunities in India are also going to be very, very good, particularly on the capital formation oriented sectors, or even companies which are going to benefit out of the Make in India or the PLI scheme. So, we have a balance of both outward as well as inward looking sectors. As far as inward looking sectors, obviously financials is a key sector, but there also, our view is that we have to look beyond only banks. So we do have some banks, but we are looking beyond banks, which would be, the non-funded financials like maybe a diversified, universal bank or even an insurance company, and match it with banks, but which are more on the value side. I would say the private corporate banks, so to say. So it's a good mix right now we have, and we are quite comfortable. Another interesting theme which we like, it's a small theme, is Indian brands focused on the tier 2, tier 3 cities and I would say towns. I think rural income is going to be very, very good. We have a third positive monsoon forecast. Those regions are less impacted with the second wave because it's predominantly an urban, phenomena. Farm prices, crop prices are very good. You have soya and cotton and sugar and all doing very well. And I think it's very logical to presume that the tier 2, tier 3 and farm income should be pretty decent. So sectors which are going to benefit out of that are something which we also like a lot.
How much of your portfolio is still following the strategy of 15, 15, 15, 15 P multiple, 15% growth? How much are you following that now?
Sure, we are following that. And, it is getting tougher because markets are moving up. But the good thing, Nikunj, is that, India is a country of entrepreneurs, and India is a country where there are so many listed companies and opportunities. I think if you are disciplined, if you keep on looking around, you are able to get decent companies, So despite, everyone has done well, but last 1 year, that 15 fund has returned some 130%. And despite that, the PE of that fund continues to be like 13.5 times, largely because the profit growth in the investee companies has been very robust. So, if a profit growth keeps on happening, then, you are making money out of the profit growth and maybe a little bit out of the re-rating. And I think that is what exactly the focus is.
So Sunil, to your mind, where are the large pools of profit? Because ultimately it's about buying large pools of profit.
So, this keeps on changing. People are now looking at steel, which is becoming a big, I would say, incremental pool of profit. If you look at some of these companies, I think they would make in this year maybe profit equal to the last 5-7 years put together. And then, recently there has been a surge in sugar. There has been again, a resurgence of pharma and chemical and so on and so forth. I think what has helped is a couple of things. One is obviously we have now a big base effect. So March of 2020 and June of 2020 were challenging quarters because of lockdowns. And this March has been a great quarter because we had pent-up demand, good growth, and no lockdowns. June 21 might have a little bit of impact because of partial lockdowns, but compared to June 20, it will still be a great year. And then you also have a scenario where companies have now started to look at expanding capacities. I think the only headwind which we see, Nikunj, is that, when we speak to companies, capex cost has started to go up. Say if a company was planning to do a capex of 500 crores, that 500 crores has become 550 or 600 crores, largely because steel prices have moved up. So, cost of constructing a factory premise, go down, machinery, they've all moved up by 20-25%. And I think that is becoming a little bit of headwind, and that might delay capex to some extent because companies might take a call that let us wait it out, let this huge run in particularly steel prices, soften a little bit. But otherwise, there is good demand. Cement, steel are obviously, as you see, good volume growth. Government spending has increased, and government spending everywhere in the world is a big tailwind for the corporate top line as well as bottom line growth. So we are in a decent spot. The only I would say advice I would like to give is that don't look at last year's return and expect 40-50% return year after year. I think you have to expect decent mid-teen returns and you will not be disappointed.
Sunil, when you say pharma, we may say pharma, but every pharma company is unique, different portfolio. It's a complete maze out there. How are you picking your spots? The 3.5, about 2 to 3 dozen listed companies are there. How are you picking your 2 or 3 names there?
Absolutely right, Nikunj. Every pharma company is very unique. So it's not possible to buy everything. So we have a few companies. Largely, our portfolio of companies which we have invested are to some extent having some COVID exposure, whether domestically or internationally. And the other thing is, we are a little bit, I would say, cash flow and value focused. So these are companies which are at max trading at a forward PE of 18 to 20 times. But as you rightly said, every pharma company is different. So I think what we have to look at is whether we have a pharma company which has a portfolio of products which are not very easy to make, they're complex, whether there are some option value upside in the next 2-3 years in terms of some approvals coming or some FTFs coming, and what has been their track record in terms of their regulatory approvals as far as their facilities are concerned. I think this becomes very important because for a pharma company, if there is a headwind in terms of regulatory issues, then you can lose 2-3 years. So I think these are 3-4 things which we like to tick mark before investing in a pharma company.
How excited are you about PSUs? We only hear intent but no action, whether it's BPCL, Container Corporation or Shipping Corporation. Periodically, markets, they get excited about owning PSU stocks. Do you think these are seasonal fruits, not permanent investments?
I think, some seasonal fruits are delicious, like our own Alfonso. But at the same time, too much of them can create rashes on your body. And I think that is what PSUs have proven from time to time. So, Nikunj, we don't want to invest in anything based on news flows. If we believe that fundamentals are in our favor, then we would definitely like to invest. One good thing is that we don't invest in companies where the return on equity visibly is less than 14-15%. And that helps us because most PSUs don't qualify, and we have stayed away from it. We have a couple of PSUs. In one fund, we have the largest public sector bank. which has obviously done well and which has not done well last 3 months. And the other is a mid-sized public sector bank. Our entry point was superb. It's reacted even now, but these are the only two PSUs we have. There is merit in trading in some of these PSUs, but you have to be very agile because a lot of these PSUs operate on the commodity front, and therefore your view on those commodities, underlying commodities, has to be perfect. We don't like to play news flow based. So just because a PSU might be sold at 50% higher than the market price, we'll go and buy. We dissuade from doing that.
Sunil, let's analyze the investment of yours. Again, we are just discussing it. Route Mobile. You bought into Route Mobile because you were bullish on the digital growth of India and the entire digital services of OTP and customization they were given. Where else are you picking up your spots in the tech space? IT services, it's always a play on buy the bad news, sell the good news. These are secular 10-12% compounders. But the real meat for a mid-cap investor like you is that you buy new themes, like you say, catch them young. Where else are you catching things young?
One is I would like to correct you, Nikunj. IT services company in India have given much higher return than 10-12%, which you mentioned. In fact, if you compare them with the so-called high-quality FMCG, these good IT companies in India have generated more cash, distributed more cash, and have grown at a faster rate than most of these FMCG companies. They grow at like 10%, 12% in dollar terms. You add 3-4% in rupee terms, they've been growing at like 15-16% year after year. And in fact, in stock market parlance, they would have become 10x in 10 years, which is a great return to be in. We continue to be optimistic and positive on the IT services company. In fact, the top 3 companies who have declared their results for March 21, all of them have seen record additions in their numbers of people they have hired. And that clearly points to the pipeline of business they are seeing as we move forward. The other thing is that this COVID has ensured that these issues of visa and travel and onshoring and all that is behind us. So in fact, they are able to offer their services at much more competitive rate. And that is even more profitable because their travel costs have come down. Third is companies globally are transforming themselves, making them digital ready. And I think that again is a big opportunity for Indian IT services companies. On the digital space, you mentioned Route Mobile. Unfortunately, I mentioned this earlier also. Most of the companies and opportunities are in the private domain. And for listed investors, the opportunities are less and far in between. But wherever you get those opportunities, I think you will have to take that call. And we are up there. We invested a small position in a travel company which got listed. We invested in a small company which is into medical equipments. There are concerns about the past and so on and so forth. I think what we look at is obviously, even if it's not a AAA company, but decent promoters with intent to be fair, in the present and the future. We are willing to give them the benefit of doubt if the tailwind as far as business and their intent is pretty decent. So I think we are in fact more than happy if companies don't attract attention in the initial phase because you are able to buy them at decent price. And as we move forward, many more companies might come up for listing and we are up there.
Sunil, I was reading a lovely quote from Mark Hausel's latest book, and he said that too much of good news and too much of bad news rarely lasts. Demand and supply catches up. What would be the turning point for you to start selling steel stocks? Will it be price? Will it be trend? I mean, ultimately, one day steel stocks will pause because steel prices cannot go up to infinity.
Which stocks?
Steel stocks, Sunil. My question is that at what point in time the steel and the commodity exposure you have, you would say, look, I think they are now richly priced. It's time for me to book profits.
So, Nikunj, steel has always been a good sector for us, right from the Reliance days. I think we were quite early between 2003 to 2008 in catching the steel cycle. you will never be able to buy it at the cheapest price and sell at the highest price. The other thing is, you can't have 15-20% of your portfolio in commodity stocks, because the way they move, the prices move higher, they can also fall lower. I think what you have to do is manage your portfolio in a way where you are able to digest this volatility, at the same time make returns out of it. So people say that these are low quality stocks. I don't agree with them. If you in fact look at the largest paint company, the cumulative 10-year profit of that company is less than 1 year profit of the steel company in India this year. So you can say that yes, the profits are up and down, but over a period of 10 years, a steel company would have made much higher profit with decent ROEs. Obviously they are capital intensive, and someone in the country will have to spend money on creating capex. Otherwise, nothing will work in this. But at the same time, don't start to project 5 year forward in a commodity company. No one can project, whether the steel prices today are 50,000 rupees a ton, whether they will be 45 or 55, even after 6 months, I can bet no one can project. And therefore, one has to be very careful of what we are getting into. Don't build your projections based on the current prices. Build your projections on maybe a 5-year, 10-year cycle, and then move forward. In fact, the best time it is said to buy commodity prices are when their P's are the highest, which means that the years are so bad that they hardly make profit. And to sell them are when the P's are the lowest, which is a year when the commodity prices are so high that they make record profits, and therefore the P's are low. So I would say that, not have more than 5% of your portfolio in very high fluctuating commodity prices. Having said that, one good thing about this cycle is that the balance sheets of a lot of these companies would be like spick and span. The biggest PSUs in this field would have reduced its debt by half in 1 year, and if the cycle continues, maybe would be debt free in the next 18 months. So balance sheets have got repaired significantly, and that also adds to the profitability. Suddenly, if you find that thousands of crores were being paid in terms of interest, and now you don't have that, even at a lower price, the profitability might be higher. So have a holistic view, and I would say don't get carried away.
Well, Sunil, there is a hack which Aisha has just said, that if you want to get carried away with your mango eating habits, you can get carried away. All you need to do, Sunil, soak them overnight in water.
I think equity is also like that. Storing in water is basically ensuring that the background work is done perfectly, so that there is no scope for only momentum to be in play.
Well, it's good to see that smiles are back, Sunil, and I sincerely hope that we see back of this corona crisis and we see genuine smiles back all over India. Appreciate your time. Stay safe, my friend.
You too.